The stock market just got a massive eviction notice, and almost nobody is paying attention. For the last year, we have been riding a massive sugar rush, fueled by artificial intelligence hype, and the illusion that the worst of inflation was completely behind us. But an absolutely chilling warning was just issued by one of the most powerful and secretive research firms on Wall Street. Citrini Research just sounded the alarm on a catastrophic threat to corporate earnings. They are calling it the high energy prices corporate earnings risk. Now, I know that sounds like a bunch of complicated financial jargon, but let me translate that into plain English for you. Imagine the entire global economy has a landlord. That landlord is the energy sector. Right now, that landlord just decided to drastically raise the rent on absolutely everyone. At the exact same time, your paycheck feels a lot smaller. The companies that make the stuff you buy have to pay way more to keep the lights on and ship their products. And suddenly nobody has any extra cash to splurge on the fun stuff anymore. This is the exact terrifying dynamic that is playing out right now. And it is forcing the smartest money on Wall Street to completely reevaluate whether this stock market rally is built on solid ground, or if it is just a fragile house of cards waiting for a strong gust of wind. Today, we are going to tear apart this institutional warning piece by piece. We are going to look at the massive profit margin squeeze that is about to hit your favorite companies. We are going to talk about a massive financial black hole that might suck all the money out of the room like a potential SpaceX public offering. And most importantly, we are going to give you the exact defensive playbook used by investing legends to protect your hard-earned money when the clueless herd runs straight off a cliff. Let us start by understanding exactly why this warning from Citrini Research is causing so much panic behind closed doors on Wall Street. You see, the mainstream financial media has been obsessing over the fact that the price of things, like used cars and televisions, has been going down. They call this a disinflationary trend. And because TVs are getting cheaper, people assumed the inflation monster was finally dead. But they completely ignored the sneaky and incredibly volatile monster hiding in the basement: energy. Sustained high energy prices are not just a scary headline you see on the evening news. They are a direct and immediate threat to the engine that drives the entire stock market. That engine is corporate earnings growth. If companies are not making more profit over time, their stock prices eventually have to crash back down to reality. To understand how this works, you need to understand something called margin compression. Let us use a very simple example. Imagine you are running a lemonade stand. You sell each cup for $2. It costs you $1 to buy the lemons, the sugar, and the cups. That means your profit margin is $1 per cup. You are feeling great. You are a successful entrepreneur. But suddenly the price of the gasoline that the delivery truck uses to bring you your lemons absolutely skyrockets. Now the delivery guy charges you more, so your cost to make that cup of lemonade jumps up to $1.50. Your profit margin just got brutally compressed down to 50 cents. You have two choices. You can either eat the loss and make less money, which makes your investors furious, or you can raise the price of your lemonade to $2.50. But here is the massive problem. The person buying your lemonade also had to pay more for gas this morning. Their wallet is already squeezed tight. So when they walk up and see your new expensive lemonade, they just shake their head and walk away. They decide they do not really need a discretionary luxury item like lemonade today. This is exactly what is happening right now. On a global scale to massive corporations, higher energy prices act like a brutal, invisible tax on the consumer. It destroys their ability to spend money on things they want, but do not absolutely need. At the exact same time, those high energy prices inflate the cost of doing business for the corporations. They pay more for electricity to run their massive data centers. They pay more for jet fuel. They pay more for the petroleum used to make the plastic in their packaging. It is a terrifying double whammy. The cost to make the product goes up, and the number of people willing to buy the product goes down. This leads to negative forward earnings revisions. That is just a fancy way of saying that Wall Street analysts have to admit that these companies are going to make way less money in the future than they originally promised. And when forward earnings go down, the stock market enters a period of derating. Prices fall across the board. Now, you might be thinking that the government will just step in and fix this. You might think the Federal Reserve will just swoop in and save the day like they always do. But the Federal Reserve is currently trapped in an incredibly dangerous nightmare scenario. The Federal Reserve really only has one main tool to fight inflation. They can raise interest rates, Raising interest rates makes it more expensive for people and businesses to borrow money. If it is expensive to borrow money, people stop buying houses and cars. Businesses stop taking out loans to build new factories. The whole economy slows down. This tool is designed to crush demand. But here is the fatal flaw in the system. The Federal Reserve cannot print more oil. They cannot drill more wells. They cannot fix a broken global energy supply chain by raising interest rates, using interest rates to fight energy. Inflation is like trying to perform delicate brain surgery with a giant rusty sledgehammer. If the Federal Reserve keeps swinging that sledgehammer to fight the price of oil, they risk completely crushing an economy that is already starting to slow down. They risk pushing the entire country into a deep and painful recession. This is not the first time humanity has faced this exact terrifying scenario. To truly understand the massive risk we are facing today, we have to take a journey back in time to the 1970s. The 1970s were a dark and miserable time for the American economy. We experienced something called the Arab oil embargo. Geopolitical tensions caused the price of oil to absolutely explode almost overnight. Suddenly, people were waiting in lines for hours just to put a few gallons of gas in their cars. This massive energy shock sent ripples of inflation through the entire economy. Everything got more expensive. But at the same time, the economy was slowing down and people were losing their jobs. Economists had to invent a brand new word to describe this nightmare. They called it stagflation. Stagnant economic growth combined with out-of-control inflation. The Federal Reserve chairman at the time was a man named Arthur Burns. He made a massive historical mistake. He kept lowering interest rates to try and save the economy. Every time things got tough, this just poured more gasoline on the inflation fire. The cost of living skyrocketed. The stock market was absolutely obliterated. People who bought popular stocks at the peak had to wait over a decade just to break even on their investments. It was a lost decade for wealth creation. It took a new Federal Reserve chairman named Paul Volcker to finally fix the problem. Volcker had to raise interest rates to astronomical levels. We are talking about mortgage rates approaching 20%. He had to deliberately cause a massive, brutal recession to finally break the back of inflation. We are currently standing on the edge of a very similar precipice. The warning from Citrini Research is essentially telling us that the ghost of the 1970s is waking up, and the consensus on Wall Street has been dangerously complacent. People are so blinded by the shiny new object of artificial intelligence that they are completely ignoring the dirty, messy reality of energy prices. We have watched a prior Citrini paper completely knock the whole stock market off its feet. The herd of investors is highly susceptible to their research. When institutions read this warning, they do not just calmly adjust their portfolios. They panic. This suggests that a messy, disorderly sell-off is highly likely. We are already seeing the cracks form in the foundation. Look at the lists of the biggest moving stocks recently. You see a chaotic mix of huge technology companies like Meta and retail giants. Like Best Buy experiencing wild swings, this is a massive warning sign. Retail investors and momentum funds are getting confused. They have been trained like Pavlovian dogs to always buy the dip. For the last 10 years, every time the market went down, you could buy it and make easy money because the Federal Reserve would always step in with cheap cash. But this dip is completely different. This dip is not a temporary glitch in the system. This dip is rooted in a fundamental challenge to corporate profit margins. The herd often fails to recognize this distinction until it is way too late. They will keep buying the dip all the way down to the bottom of the ocean. So how do we survive this? What is the contrarian play? The first order thinking is simple and obvious. If energy prices are going up, you sell airlines because they buy a lot of jet fuel. And you buy oil companies because they pump the oil. But that is amateur hour. To truly build wealth, you need sophisticated second-order thinking. You need to look way deeper than the obvious headline. The real secret is finding companies that have massive, unassailable pricing power. Pricing power is the holy grail of investing during an inflationary storm. Let us go back to our lemonade stand analogy. Imagine you are not selling generic lemonade. Imagine you are selling a magical life-saving medicine that people literally need to survive. If your delivery costs go up, you can raise your price to whatever you want. The customer might be angry, but they will still buy it because they have absolutely no other choice. That is true pricing power. Companies that dominate consumer staples or provide critical infrastructure have this power They can easily pass their higher energy costs directly on to the consumer, without losing any sales. These companies will vastly outperform the weak businesses in highly competitive, low-margin industries. But there is an even deeper level to this game. Third-order thinking involves understanding the massive, hidden flows of capital around the world. As the broad stock market becomes less attractive due to this massive margin risk, all of that giant institutional money has to go somewhere. It will aggressively hunt for unique stories. It will look for secular growth, narratives that are completely insulated from the normal economic cycle. Let us talk about a perfect example. There are massive rumors circulating about a potential initial public offering for SpaceX. This is not just a regular company going public. This is a monumental generational event. A company like SpaceX represents the future of humanity. It represents space exploration and satellite internet, and things that have absolutely nothing to do with the price of gasoline in Ohio. An event like a SpaceX public offering acts like a giant capital magnet. It can literally suck the liquidity out of the rest of the market. Portfolio managers will gladly dump their boring retail stocks to get a piece of a high-growth narrative that is untethered from the mess on the ground. The true contrarian move is not just to hide under the bed and get defensive. It is to actively identify these massive capital magnets that can thrive in an otherwise challenging environment. So let us break down exactly what the smartest money is doing right now. The bond market is currently flashing massive warning signs. The bond market is like the canary in the coal mine for the global economy. When Citrini warns about persistently high energy prices, it forces investors to expect higher inflation for a longer period of time. This puts massive upward pressure on Treasury yields, especially on the short-term bonds. This creates a terrifying phenomenon known as a yield curve inversion. Normally, if you lend the government your money for 10 years, they pay you a higher interest rate than if you lend it to them for 2 years. That makes logical sense because you are taking on more risk by locking your money up for a longer time. But right now, the system is broken. Short-term interest rates are actually higher than long-term rates. Imagine a seesaw that is completely tilted in the wrong direction. A yield curve inversion is a classic, historically proven signal that a major recession is coming. The smartest and wealthiest investors in the world watch this indicator like a hawk. At the exact same time, the corporate debt market is starting to panic. The risk of margin compression means that weak companies might not make enough money to pay back their massive debts. This means credit spreads are going to widen. It becomes incredibly expensive for risky companies to survive. We are watching a rapid, palpable shift in how the mega-wealthy are positioning their portfolios. They are moving from a state of greedy risk, taking to a state of extreme risk awareness. This Citrini note provides the perfect intellectual excuse for hedge fund managers to finally dump their risky growth stocks. We are literally watching these funds increase their bets against transportation companies and consumer discretionary brands. They know the consumer is tapped out. Instead, they are rotating their billions of dollars into energy producers and boring companies that sell things people cannot live without. The high number of stocks making wild moves before the market even opens is proof that active managers are not waiting around to see what happens. They are aggressively reorganizing their portfolios right now, and you need to do the same. This brings us to the Titans playbook. This is our strategic manual for surviving and thriving in this brutal economic condition. Step 1 is understanding the generational bargain. We are talking about the eternal battle between fear and greed. This Citrini warning is a calculated introduction of fear into a market that had become wildly complacent. It is an institutional-grade bucket of freezing cold water. But legends like Warren Buffett do not run around, screaming and panic selling when the market drops. Instead, they sit quietly and scrutinize their portfolios. They look for companies with deep, durable, competitive moats. A moat is just a massive advantage that protects a business from its competitors. Buffett wants companies that can effortlessly pass the cost of inflation onto their customers. He views broad market panic as a beautiful opportunity to buy more of these incredible businesses at a steep discount. Another legend named Sir John Templeton was a master of doing the opposite of the herd. He actively hunted for bargains at the absolute point of maximum pessimism. When everyone else was terrified, he was buying. He would look at the sectors being unfairly punished by the energy panic and find hidden gems. Both of these investing titans would agree on one crucial thing today. This is a time for a very sharp pencil and a very steady hand. It is absolutely not a time for emotional, impulsive reactions. Step 2. is implementing the 55-35-10 seesaw strategy. We are radically adjusting our model portfolio to a highly defensive posture. This directly reflects the terrifying margin compression risk. We have been discussing the new ideal allocation is exactly 55% in solid stocks, 35% in safe assets, and 10% held in pure cash. The entire goal here is to reduce your exposure to wild market swings, while building a massive bunker to protect you against economic, slowing and stubborn inflation. For the stock portion of your portfolio, we highly recommend a core holding in a broad market fund like the SPY. This gives you a piece of the 500 largest companies in America, but you must complement that with a heavy dose of the energy sector, using a fund like the XLE. This is your direct armor against the core risk of rising oil prices. If the market crashes because oil goes up, your energy fund will skyrocket and protect your wealth. On the safe assets side, you need to build a strong position in intermediate-term government bonds, using a fund like the IEF. When the stock market panics, big money floods into the safety of government bonds, driving their price up. You also need an allocation to gold using a fund like GLD. Gold has been humanity's ultimate hedge against inflation and currency debasement for thousands of years. This week, your immediate action item is to sell off your exposure to consumer discretionary companies. Using the XLY fund, these are the companies selling luxury items that nobody can afford anymore. Take that money and move it directly into the safety of government bonds. Step 3 is understanding the global shield. In this terrifying environment of worldwide uncertainty, United States assets remain the absolute superior choice for your money. The United States is a massive global energy producer. We pump millions of barrels of oil every single day. This gives the American economy a massive layer of insulation from global energy shocks. Pure energy importers in Europe and parts of Asia do not have this luxury. They are completely at the mercy of the global markets. This relative American strength, combined with the fact that the Federal Reserve is basically the central bank for the entire planet, drives a massive flood of panic money into the United States dollar. When the world gets scary, rich people buy dollars. A stronger dollar is great for America, but it is an absolute nightmare for emerging markets. Countries that borrowed money in United States dollars suddenly find it impossible to pay back their debts because their local currency is becoming worthless, while China struggles with massive internal real estate collapses and demographic issues, and Europe faces a crippling energy crisis. The United States market stands tall. It is often called the cleanest dirty shirt in the laundry basket. It might have some stains, but it is far better than every other option available to global investors. Step 4 is mastering survival mechanics. This is absolutely not a market where you take your entire life savings and dump it into stocks all at once. You must use a strategy called dollar cost averaging. This means you buy a little bit over a long period of time, regardless of the price. We strongly advise holding that strict 10% cash allocation in your portfolio. That cash is your ammunition. You do not use it to buy a new television. You deploy it opportunistically during periods of absolute macro-driven terror. When the broad market drops by 5 to 7% because of a scary headline that is your trigger, you take a quarter of your cash stash and you buy your absolute highest conviction stocks at a massive discount. Furthermore, you must immediately institute the 50% panic sell rule to protect your own psychology. Investing is an incredibly emotional game, and your brain is wired to make the worst possible decisions at the worst possible times. If the market is crashing and you feel an overwhelming physical urge to completely sell out of a great company just to stop the pain, you must force yourself to only sell half. This simple mechanical rule satisfies your primitive emotional need to run away from danger, but it prevents you from making the catastrophic mistake of selling everything right at the absolute bottom. By keeping half your money in the game, you ensure that you will participate when the market eventually rebounds. You can always reevaluate the remaining 50% with a calm, rational head. 24 hours later, let us review exactly what you should and should not do right now. Your first immediate action is to buy a 2% position in the energy fund XLE if it pulls back by 5% from its recent highs. Use that temporary weakness to build your armor against the primary threat facing the market. Your second action is to add 3% to your bond position in IEF on any day that the main stock market closes significantly below its 50-day moving average. The 50-day moving average is a massive psychological line in the sand for institutional computers. If the market falls below that line, it confirms that the big money is panicking and you need more safety. Your third action is to initiate a 1% position in the massive technology fund. QQQ, if the market drops by 8 to 10%, technology companies are mostly immune to the cost of gasoline. If they drop because of general market panic, you are getting a massive discount on the future of human innovation. Now, for what you must absolutely avoid, do not under any circumstances chase low-quality, cyclical stocks that carry massive amounts of debt just because their stock price looks cheap today. These are the worst possible companies to own right now. They have zero pricing power. They have vulnerable balance sheets that will be crushed by higher interest rates. The margin compression we talked about will hit these zombie companies first, and it will hit them the hardest. They are not bargains. They are value traps waiting to destroy your money. Finally, do not ignore the massive rise in other commodity prices beyond just oil. While the Citrini report focused heavily on the energy sector, this dynamic is playing out across the board. The price of copper, the price of aluminum, the price of agricultural food commodities are all flashing red warning signs. If you only watch the price of gas, you are flying completely blind to the massive wave of input cost inflation that is about to slam into industrial and consumer businesses worldwide. Macroeconomic headwinds like the ones we are facing today are the ultimate test of your investment strategy. They are not a reason to surrender and hide your money under a mattress. You must focus intensely on exactly what you own and exactly why you own it. The environment we are walking into feels terrifyingly similar to the brutal oil shocks of the late 1970s. That period completely destroyed the wealth of anyone who was unprepared and overly optimistic. The absolute most enduring lesson from that dark era of history was very simple. In the middle of a raging inflationary storm, real tangible assets and incredible companies with unassailable pricing power become the undisputed kings of the financial world. This is definitely not a time to bet your financial future on blind hope and momentum. It is a time to ruthlessly invest in absolute resilience. We couldn't fit all the deep dive details into this video. Check out the Warm Insight newsletter in the pinned comment and description for a deeper dive and the full text summary. See you there.